Today we're going over a largely overlooked but still very important financial metric, and that is market cap. You've probably noticed this metric anytime that you look up a stock on Google because it's always plastered on the front page. But for some reason, most people either don't look or don't even care enough to know what the market cap of a company they're about to invest in is. And that is f***ing stupid. So let's change that in today's video. Today is day 19 of 100 Days of Finance, where the entire goal is to give you more personal finance education in 100 days than most people receive in their entire lifetime. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's keep it short, sweet, and let's get right into it. So the simplest explanation of market capitalization is that it's a metric that represents the total value of a company's outstanding shares. Cool. Why does it matter? We'll get there, I promise. But first, it's calculated by multiplying the current stock price by the total number of outstanding shares. The resulting number represents the market's perception of the company's value. Quick example, because examples make everything easier. Company A has 125,000 outstanding shares. This number is basically the total shares of ownership that the company has issued. Another way to think of this, that they basically broke up the company into 125,000 tiny pieces and sold those pieces of ownership to people like you and me. So if we want to know what the company is worth as a single piece, we need to take all of those shares and add them together. But in order to do that, we need one more piece of information, and that is how much each share is worth individually, basically its price. And for this example, let's say that the company is currently trading at $20 a share. Very simple, all we do is multiply those two numbers together. 125,000 outstanding shares times $20 per share. That equals 2.5 million or $2,500,000. Now, what the fuck does this even mean? Well, in essence, it means that that is what the market believes the company is worth. If I could buy all the shares, I would need $2.5 million to take full ownership of the company. Okay, but why does that matter when it comes to investing? Well, really, it's used by investors, analysts, and financial institutions to determine the size, stability, and growth prospects of a company. Let me explain. Generally, the higher a company's market capitalization, the more established and stable it is perceived to be, while a lower market cap is usually associated with smaller, more risky companies. That is usually true, but not always. A small company can still be very established, perhaps it just operates in a smaller industry. Or, as we have seen plenty of times, very new and risky companies IPO onto the market with a valuation of billions of dollars. So while a higher market cap usually means more stable, in reality, it just means larger. With that said, larger market cap stocks tend, and I put that in quotations because it's mostly true, tend to move slower and more predictably. Now, there are three primary categories of market capitalization: large cap, mid cap, and small cap. Large cap companies can usually be defined as a market capitalization of over $10 billion. Mid caps can usually be categorized as a market capitalization between $2 and $10 billion. And small cap companies tend to have a valuation of $2 billion and below. There are also mega cap companies like Apple and Amazon with valuations of well over $100 billion. Now, the smaller the market cap, the more volatile the stock tends to be. And that is simply an expression of the power of money. The smaller the valuation, the more power each dollar has relative to the company's total value. That means that $100 has more relative power to a $1 million company as opposed to a $1 billion company. So smaller companies' stock tend to be more volatile simply because it takes less dollars to cause a significant move up or down. Some companies are small enough that a single investor with a couple of $1 million sitting around can cause a huge move up or down by just buying a large portion of the stock. That is much harder to do if the company is, say, worth $100 billion, because each individual dollar is a smaller percentage of the company's total valuation. So while market cap by itself does not tell you the health or the growth prospects of a company, it can give you insight to its size and how volatile the stock might be if you decide to purchase it. One more thing to note. If If a company has a much smaller than average market cap compared to the average for the companies in that industry, you should dive deeper into why. Does the company just suck and can't seem to compete with the other companies? Or is the company just new? And if it is just new, does it have good leadership or a good idea or a better way of doing things? Because if it does, there might be a lot of room for growth, and all the company needs is just time. I hope this video was informative and fun to watch. I love this stuff. It's been my passion for over a decade, and I love to be able to share that with you guys. In tomorrow's video, we're going to go over how to structure your portfolio just like a millionaire investor would, based on your age and your risk tolerance. So make sure to subscribe if you haven't already, and make sure to turn on the bell notifications so you don't miss that video and all the other videos as we continue our journey of 100 days of finance. As always, my name is Derek, and I got my degree in finance so you don't have to, and I will see you in tomorrow's video.